43% of Americans can't cover a $1,000 emergency from savings. Let that sink in for a second. Almost half the country is one unexpected expense away from going deeper into debt while they're already trying to pay off the debt they have. And most of them picked a payoff strategy without ever running their actual numbers first. Maybe that was you. You heard about the Snowball method, or the Avalanche, or someone told you to get a HELOC. So you picked one, started making payments, felt like you were doing the right thing. But here's the question almost nobody asks before they start. What happens to my plan when life happens? Not if, when. Because life always happens. The car breaks down, the water heater goes, a medical bill shows up, and suddenly 3 months of debt progress disappears in one weekend. And people think, I failed. I'm bad with money. But that's not what happened. What happened is, the strategy was never designed to survive real life. Today, I'm walking you through all 4 major debt payoff strategies: Snowball, Avalanche, HELOC, and banking strategy, with real numbers, not hypotheticals. What each one does well, where each one breaks down, and how to figure out which one actually fits your life. No shaming. No, just stop buying coffee. No pushing one strategy on everyone. I'm Deb from True Freedom Financial. Let's get into it. Let's start with the problem nobody talks about. Before we get to the strategies, I need to talk about the thing most debt content completely skips. The actual reason most debt payoff plans fail. And it's probably not what you think. Most people assume plans fall apart because of discipline, willpower, self-control. And look, discipline matters. But I've worked with people who had incredible discipline, and their plans still fell apart because they built the plan wrong from the start. Here's the pattern I see over and over. Reason 1, they picked a strategy based on what sounded right, not what their numbers said. You hear about the Snowball method. It makes sense on paper. You start there. But nobody ever asked, is Snowball actually the fastest or cheapest way for your specific debt mix? Sometimes it is. Sometimes it costs you thousands more than a different approach. You don't know until you run the numbers. Reason 2, the plan has no emergency layer. This is the big one. Most debt payoff plans are built on one assumption: everything goes perfectly. You make your payments every month, the debt disappears on schedule, done. But almost a third of Americans, 29%, can't afford an unexpected expense over $400. So when life hits, they go right back into debt, and they have to start over. Reason 3, they're optimizing for one thing instead of their whole picture. Some strategies pay debt off faster but leave you with zero savings. Some cost more in interest but give you access to capital. And some, the more advanced ones, let you build capital while you pay off debt. But you can only see that if you're looking at all 4 options side by side. Reason 4, they picked a strategy they don't even qualify for. Some strategies require home equity. Some require qualifying for a specific insurance product. Some require a certain credit score or income profile. Nobody tells you this up front. So people get excited about an advanced strategy, try to implement it, and hit a wall they didn't know was there. The strategy isn't the problem. The mismatch between the strategy and the person is the problem. And that's exactly what Debt GPS was built to solve. But before we get there, you need to understand all 4 strategies, because you can't compare something you don't fully understand. Let's start with the 2 most popular ones. Strategy 1, Debt Snowball. The Debt Snowball was made famous by Dave Ramsey. And I want to be clear, there's a reason it became popular. It works for a lot of people, but it's not the right choice for everyone. Understanding exactly how it works and where it breaks down will help you figure out if it's right for you. How it works: you list all your debts. You put them in order from smallest balance to largest balance. Interest rate doesn't matter at this stage, balance only. You make minimum payments on everything. But every extra dollar you can put toward debt goes to the smallest balance on your list. When that balance hits zero, you take the full payment you were making on it and roll it onto the next smallest debt. The minimum plus the extra. All of it. That's the snowball. Each debt you pay off adds momentum, more money rolling onto the next one, getting paid off faster, rolling onto the next one. Let me show you a real example. Say you have credit card A, $800 balance, 22% interest. Credit card B, $30,500 balance, 19% interest. Car loan $200 balance, 7% interest. Student loan $14,000 balance, 5.5% interest. Total about $26,500 in debt. With the snowball method, you attack that $800 credit card first, regardless of what interest rate it has. Everything else gets the minimum payment. Every extra dollar goes to the $800. When it's gone, everything that was going there, the minimum plus your extra, rolls onto the $3,500 card, and so on until everything is paid off. Why it works. The research on this is real. Studies have shown that people who focus on eliminating individual accounts versus making progress across all accounts are significantly more likely to stay motivated and follow through. The quick wins create momentum. You see a zero balance, your brain registers an accomplishment, and you keep going. That psychological reward is not a small thing. Debt payoff is a long game. You need fuel to stay in it. Snowball provides that fuel in a way that pure math does not. This is the single biggest strength of the snowball method. It's designed for human beings, not spreadsheets. Where it breaks down, now the honest part. If your smallest balance also happens to carry the highest interest rate, then snowball and math are aligned, and you're fine. But what if your debt mix looks different? What if you have a small balance at a low interest rate and a large balance at a very high interest rate? Snowball will have you paying down the cheap debt first while the expensive debt keeps compounding. In some cases, that difference can cost you hundreds or thousands of dollars more over time compared to a different approach. The other thing nobody talks about, Snowball doesn't have a built-in emergency mechanism. You're paying down balances aggressively, but you may not be building a meaningful cash cushion at the same time. So when life happens, and it will, you often end up going right back into debt to cover it, and then you have to start the snowball over. The other honest truth, Snowball is optimized for psychological momentum, not mathematical efficiency. If you have strong discipline and want the most cost-effective path, there's a different strategy for that, which is exactly what we're going to talk about next. Strategy 2, Debt Avalanche. The debt avalanche is the mathematically optimal way to pay off debt. Meaning, if you follow it exactly, you will pay less in total interest than any other sequential payoff method. How it works, same setup. List all your debts. But this time, order them from highest interest rate to lowest, completely ignoring the balance size. Minimum payments on everything. Every extra dollar goes to the highest interest rate debt first. When that's paid off, everything rolls to the next highest rate. And so on. Same debt example. Credit card. A, $800 balance, 22% interest. Hit this first credit card. B, $3,500 balance, 19% interest. Second car loan, $8,200 balance, 7% interest. Third student loan, $14,000 balance, 5.5% interest. Last. In this particular example, the order happens to be the same as Snowball, because the smallest balance also has the highest interest rate. But change that debt mix, put a $12,000 balance at 24% at the top, and the order changes completely. Snowball would ignore it until the smaller debts were gone. Avalanche attacks it first. Why it works? By attacking the highest interest rate first, you're eliminating the debt that is costing you the most money per month. Every extra dollar applied to a high-interest balance saves you more over time than the same dollar applied to a low-interest balance. Over the life of a payoff plan, this can amount to hundreds or thousands of dollars in savings compared to Snowball, depending on your specific debt mix. If your goal is pure cost efficiency and you have the discipline to execute it, Avalanche wins the math every time. Where it breaks down, Avalanche assumes your highest interest debt is manageable to attack head-on. But what if your highest rate debt is also your largest balance? You could be months or even a year into the plan before you see a single zero. That's the psychological challenge with Avalanche. It requires patience. And for people who need visible wins to stay motivated, it can feel like nothing is happening. A cheaper plan you abandon is worse than a slightly more expensive plan you complete. I want you to really sit with that for a second. The other problem? Same as Snowball. No built-in emergency layer. One unexpected expense and the plan is disrupted. You don't go into Avalanche any better prepared for life happening than you do with Snowball. So, which one is better? Here's my honest answer. It depends on the person and the numbers. And you need to run both before you can know. Now let's compare Snowball and Avalanche with real numbers. I see a lot of content that says Snowball is for emotional people, Avalanche is for logical people, and that is an oversimplification that has probably cost people real money. Here's what the actual difference looks like in practice. Scenario A, your smaller balances happen to carry higher interest rates. The two strategies are aligned. The difference in total interest paid might be $150 to $400 over the life of the plan. Not a game changer. Pick whichever one keeps you motivated. Scenario B. Your debt mix has one large balance at a very high interest rate, say a $12,000 credit card at 24%, and several smaller balances at lower rates. Now, the difference between Snowball and Avalanche could be $2,500 to $3,000 or more. The point is, you don't know which one is better for you without running your specific numbers. And most people never do. They pick a strategy based on what they heard and hope it was the right call. Even if Snowball costs you $1,000 more in interest, it might still be the right choice, because you'll actually finish it. A slightly more expensive plan you complete is worth more than a mathematically perfect plan you quit. This is why comparison matters more than theory. But we're not done yet, because Snowball and Avalanche are only two of four options. And the next two are where things get interesting, because they approach the problem from a completely different angle. Let me stop here first, though, and talk about the thing that makes all of this fall apart. Now let's talk about why both can fail when life happens. This is the part of debt payoff that almost nobody talks about. And I think it might be the most important section of this entire video. Snowball and Avalanche are both built on a silent assumption. Your income stays stable. Your expenses stay predictable. Nothing unexpected happens. But that is not how life works. Scenario 1, the emergency expense. The car breaks down. $1,800 repair. You don't have the cash because every extra dollar has been going toward debt. So you put it on a credit card, the card you just paid off, and now you're back where you started. Except you've also lost months of progress, paid interest on money you borrowed twice, and your motivation is shot. I see this story all the time. Someone posted on Reddit recently. They'd consolidated their credit card debt with a personal loan, felt great, and then didn't change their habits. Charged another 10Ks. Now they're worse off than before. Scenario 2, income disruption. You lose your job. Hours get cut. A health issue affects your ability to work. Suddenly, the $400 extra you were putting toward debt is gone. You can't make progress. In some cases, you can't make minimums. The plan doesn't just pause, it starts to reverse. Scenario 3, the second emergency. This is the one that breaks people psychologically. It's not the first emergency. Most people can handle one setback. They dust off, recalibrate, keep going. It's when the second emergency comes right after the first one. The first emergency wiped out their savings. The second one sends them back into debt. And now they're deeper than when they started, and they feel like they're in a hole they'll never get out of. I've had people describe this exact sequence to me, and every time my response is the same. This is not a failure of discipline. This is a failure of plan design. The question is never just, which strategy pays off debt fastest in a perfect world? The real question is, which strategy can survive the world I actually live in? And that means your strategy needs to account for emergency access, cash flow, flexibility, capital building, not just interest math. That's where strategies 3 and 4 come in. I want to be upfront with you. These are more advanced. Not everyone will qualify. And they're not right for everyone. I'll be completely honest about that. Let's talk about the HELOC strategy first. Strategy 3. HELOC strategy. HELOC stands for Home Equity Line of Credit. If you're a homeowner with equity, this strategy has real potential. But it also comes with real risks that a lot of people seriously underestimate. What is a HELOC? A HELOC is a line of credit that uses your home's equity as collateral. Simple example, your home is worth $350,000 and you owe $200,000 on your mortgage. You have $150,000 in equity. A lender might let you access a portion of that, say $60,000 to $80,000, as a revolving line of credit. The key difference from a personal loan? The interest rate on a HELOC is typically much lower than credit card rates. We're often talking 8 to 10% versus 20 to 24%. That gap is meaningful. On $20,000 of credit card debt, that could be the difference between $4,400 a year in interest and $1,800 a year in interest. That's $2,600 a year staying in your pocket instead of the bank's. How the debt payoff strategy works. The basic approach, you use your HELOC to pay off your high-interest debts. Instead of paying 24% on credit cards, you're now paying the HELOC rate. Lower rate means more of each payment goes to principal, and you pay it off faster. The more advanced version, sometimes called velocity banking, uses your HELOC as a cash flow management tool. You direct your entire income into the HELOC, use it to cover living expenses, and the result is that your average daily balance stays lower. Lower average daily balance means less interest accruing, which means faster payoff. This is a real mathematical strategy. When it works, with the right person, the right numbers, and the right discipline, it works well. When it makes sense, here's the real checklist. You own a home with meaningful equity. Your credit score qualifies you for a reasonable rate. You have stable, consistent, predictable income. The cash flow approach only works if cash flow is actually predictable. You have the discipline to treat the HELOC as a tool, not a credit line to spend. You fully understand that your home is the collateral when it doesn't make sense. And I want to be very direct here because I've seen too many people pushed into this strategy when it wasn't right for them. If your income is irregular or inconsistent, the cash flow approach loses its effectiveness and can actually backfire. If you have a history of running up revolving credit, a HELOC can become a way to consolidate and then run both the HELOC and the original accounts back up. That's worse than where you started. I've seen it happen. If interest rates rise, a variable rate HELOC can become more expensive than you planned. If your home loses value, you could end up with less equity than you started with. And most importantly, you are putting your home on the line. This is secured debt. If you can't service the HELOC, the stakes are higher than with unsecured credit cards. The bottom line on HELOC, this strategy can genuinely accelerate debt payoff and reduce the total interest you pay. For the right person, it's a powerful tool. But the right person is a homeowner with equity, stable income, strong credit, and the financial discipline to execute the strategy without using the open line as spending money. Not everyone has all of those things. And that's completely okay. Because there's a fourth strategy I want to tell you about. One that approaches the problem from a completely different angle. Strategy 4, banking strategy, also known as infinite banking. Okay. I want to take more time on this one than the others because it is the most misunderstood of the 4 strategies. You may have heard it called infinite banking. The banking strategy. becoming your own banker. And depending on who you've heard it from, you might have one of two reactions. Either it sounds like the most exciting financial tool you've ever heard of, or it sounds like a scam. I want to give you the honest middle ground, because both of those reactions are understandable, and neither one is the full picture. What it actually is, at its core, the banking strategy uses a specially designed whole life insurance policy as a financial tool, not primarily for the death benefit, though the death benefit matters and we'll get to that, but for the living benefits, specifically the cash value. Here's how it works. You purchase a whole life insurance policy that has been structured for maximum cash value accumulation, not maximum death benefit. This distinction is critical. Most whole life policies you'll encounter are not set up this way. A banking strategy policy is built very specifically, and you need to work with someone who knows how to structure it correctly. As you pay premiums, a portion accumulates inside the policy as cash value. That cash value grows at a guaranteed rate, regardless of market conditions, is tax-advantaged inside the policy, is accessible to you through policy loans, and here's the key mechanic. You can borrow against your cash value to pay off debt, cover emergencies, make purchases, whatever you need. And while your money is loaned out, the cash value continues to grow as if you hadn't borrowed it. You pay yourself back at an interest rate you control, on a schedule you control. There is no mandatory repayment timeline. No bank approving your loan request. No credit check. How this applies to debt payoff. You take a policy loan to pay off high-interest debt. Instead of paying 24% to a credit card company, you are paying back your policy, building your own asset at the same time you eliminate the debt. The strategy essentially turns your debt payoff payments into capital that you accumulate and own, rather than interest that disappears into a lender's pocket. Why this is fundamentally different from the other three strategies. Snowball, Avalanche, and HELOC are all answering the same basic question: what's the most efficient route to zero? The banking strategy asks a different question altogether. What if the act of paying off debt also built you an asset you own, control, and can use for the rest of your life? That asset, the cash value, becomes your emergency fund, your capital reserve for future purchases, a place to store and grow money with guaranteed returns, a tool you can use again and again for cars, businesses, real estate, anything. The life insurance and family protection angle. Here's something that doesn't get enough attention in these conversations. Every one of these policies comes with a death benefit. That means while you're building this financial tool for your own debt payoff and capital building, you are also building family protection into the same vehicle. Your family is covered while you're building wealth. If something happens to you during your debt payoff years, the years when your family is most financially vulnerable, there is a benefit there for them. That's not a small thing. That's the piece that makes this feel like a true financial foundation, not just a strategy. Where it breaks down, and I'm going to be completely honest here, this strategy is not for everyone. Full stop. And I'd rather tell you that clearly than have you find out the hard way. First, you need to medically qualify. These are life insurance policies. If you have significant health issues, you may not qualify, or your premiums may be high enough to change the math entirely. Second, cash value takes time to build. In the early years of the policy, your accessible cash value is lower. This is a long-term financial tool. If you need to be out of debt in 18 months, this is probably not your primary mechanism. Third, the structure of the policy matters enormously. A poorly structured whole life policy is a terrible financial product. A well-structured banking strategy policy is a completely different tool. These are not the same thing, and you need to work with someone who knows the difference and will show you the numbers transparently. Fourth, it requires commitment. Premiums must be paid to keep the policy in force. This isn't something you can set up and pause when cash is tight. It requires planning and consistency. For the skeptics, I hear you. There are real cases of people being burned by whole life insurance products. And almost always the story is the same. They were sold a policy that wasn't right for their situation, or one that wasn't structured correctly for the strategy. The product matters as much as the concept. A hammer is a great tool. A hammer sold to someone who needs a screwdriver is a bad outcome, and it's not the hammer's fault. Who the banking strategy is for: people who want to pay off debt while building capital simultaneously. People who value control over their money and want a place to store and grow it outside the market. People who want a financial tool that serves debt payoff, emergencies, future purchases, and family protection, all in one vehicle. And people who are thinking about their financial picture not just for the next 3 years, but for the next 30. If that description fits you, this is worth a real conversation, but only with someone who will show you the math transparently and tell you honestly whether it fits your situation. Not everyone qualifies, and that's okay. I want to spend a moment on something I don't think gets said enough in financial content. Not every strategy is available to every person, and that is not a failure. It's just information. HELOC requires home ownership and equity. You might not be there yet, and that's okay. Banking strategy requires medically qualifying for a life insurance policy. Health history is a factor, and that's okay. Even the debt avalanche, technically the most mathematically efficient method, might not be right for you if your personality means you'll abandon it before it's finished. The goal is not to find the best strategy in theory. The goal is to find the best strategy for you, your income, your debt mix, your risk tolerance, your timeline, your access to tools, your life. And the only way to find that is to actually look at your numbers inside each of those frameworks. Not a hypothetical person's numbers. Not a YouTube example. Your numbers. When you can see all 4 strategies side by side with your real data, the decision stops being theoretical. It becomes obvious. That is exactly what Debt GPS was built to do. And I want to show you how it works. Now let's talk about the Debt GPS calculator. Let me make this concrete. The Debt GPS calculator takes your real information and models all 4 strategies: debt snowball, debt avalanche, HELOC strategy, banking strategy. You input your debt balances, your interest rates, your minimum payments, your extra monthly payment capacity, and the calculator shows you, side by side, for each strategy, how long it takes to pay off your debt, how much total interest you'll pay, what your cash flow looks like during the payoff period, which strategy is most efficient for your specific mix. This is the moment where people usually say, "Wait, I had no idea there was that much difference." Because until you see your own numbers compared across 4 strategies, you're just guessing. And guessing is expensive. In real cases, we're talking about the difference between being debt-free in 3 years versus 5 years. Or $4,000 in interest versus $9,000. These are not small differences. These are life differences. What about the advanced strategies? If your numbers show that HELOC or banking strategy could be a strong fit for your situation, that's where a real conversation comes in. The calculator shows you the math. A real conversation with a licensed professional who understands your full picture shows you whether you qualify, what the process looks like, and whether it actually makes sense for your life. And if the advanced strategies aren't the right fit for you right now, knowing that is still valuable, because it means you can pursue Snowball or Avalanche with confidence, knowing it's the right choice, not just the default. Here's what I want you to do. In the comments below this video, drop the word GPS. Just that. One word, and I will send you the Debt GPS calculator. No spam, no pressure, just the tool to help you compare your options. You input your numbers. You see all 4 strategies compared side by side. And you walk away knowing which path forward actually makes sense for your situation. If after running your numbers you want to have a real conversation about whether you qualify for HELOC, whether banking strategy makes sense, whether you want to dig deeper, you can book a free consultation. Zero pressure. Link in the description. Before I let you go, I want to come back to where we started. 43% of Americans can't cover a $1,000 emergency, and almost all of them are trying to pay off debt at the same time. That's not a discipline problem. That's a plan design problem. You're not bad with money. You're not undisciplined. You may just be following a plan that was never designed for the life you actually live. That changes today. Comment GPS below. Run your numbers. Make an informed decision. And let's get you moving in the right direction, with a map this time. I'm Deb from True Freedom Financial. If this video gave you clarity, share it with someone who needs it. And I'll see you in the next one.